What if I told you that the next decade of your life could look completely different, all depending on how you choose to invest just $10, $1,000, or $10,000 today? It seems almost impossible that such small decisions could have such a big impact. But the numbers and thousands of real-life stories tell us otherwise. Imagine you right now facing 3 doors. Behind each door, a different starting amount, a different path, and a whole new set of challenges and opportunities. Which would you choose? And more importantly, how would you make the most of it? Let's break open the mystery of the $10 versus $1,000 versus $10,000 investing challenge and see how smart decisions and a little bit of patience can transform even the modestest sum into something meaningful. First, let's talk about what makes these challenges so compelling. Recently, investment communities have been buzzing about long-term contests like the 10-10-10 Investment Challenge. In this real-world game, participants start with $10,000, aiming to grow it as much as possible over 10 years, with the winner taking home a major prize. But the real lesson isn't just about winning. It's about how consistent, thoughtful investing, even with smaller amounts, can lead to surprising results when given enough time. The challenge is as much about learning discipline and patience as it is about picking the right stocks. But what if you're not starting with a $10,000? What if all you have is a crumpled $10 bill or maybe $1,000 you've scraped together from some side gigs? Does it even make sense to invest such small amounts? The answer is a resounding yes. And here's why. Let's start with the basics. Compound interest. This is the secret sauce that makes even small investments powerful over time. Think of it as earning money on your money and then earning even more on those earnings. The earlier you start, no matter how little, the more time you give compound interest to work its magic. If you've ever read The Psychology of Money by Morgan Housel or Rich Dad Poor Dad by Robert Kiyosaki, you'll know. The biggest advantage isn't how much you start with, but how soon you start. So, let's do a quick reality check. What can you actually do with $10? With $10, your options might seem limited, but you're not powerless. You could buy a single share of a low-cost ETF, like the S&P 500, using platforms that allow fractional investing. Some people even use $10 to test the waters on demo accounts in investment challenges. These platforms let you practice trading with virtual money, helping you learn the ropes before risking more. While you won't get rich overnight, your real win here is building the habit. It's like going to the gym. The first day might not make a visible difference, but it sets you on the right track. If you invest $10 every month, and your investments grow at an average of 7% per year, the historical average for the stock market, after 10 years, you'll have about not enough to retire on. But a clear reminder, doing something is always better than doing nothing. Now let's level up. What about $1,000? With $1,000, you're playing a very different game. You have enough to diversify, maybe a mix of index funds, a few individual stocks, or even dipping your toes into digital assets or high-yield savings accounts. You could use the 50-30-20 rule to decide how much to invest, spend, and save. Or, if you want to go all in, you might try a dollar-cost averaging, investing a set amount regularly, regardless of market ups and downs. This smooths out your risk and takes the emotion out of investing. Let's say you put that $1,000 in an index fund and leave it alone for 10 years, growing at 7% a year. By the end, you'll have almost $2,000 without doing anything but being patient. If you commit to adding $100 every month, that grows to over $17,000 in a decade. That's the power of consistency and compound growth. But what if you're feeling ambitious? Or maybe you've managed to save up $10,000. This is where things get interesting. With $10,000, you can really start to leverage the strategies used by participants in challenges like the 10-10 Investment Challenge. You could build a well-diversified portfolio, experiment with a portion in riskier assets, and even set aside some for new opportunities that come your way. The key here is to avoid putting all your eggs in one basket. Diversification helps protect you when the market gets rough. If you invest $10,000 in a simple portfolio and let it grow at that same 7% per year, in a decade, you'll have almost $20,000. But here's where mindset matters. The most successful investors aren't just chasing returns. They're managing their emotions. They avoid emotional spending, resist lifestyle inflation, and focus on delayed gratification. Remember the marshmallow test? The ability to wait, to let your investments grow undisturbed, is one of the strongest predictors of financial success. So, what should you actually do starting today? First, be honest with yourself about what you can afford to invest. Even if it's just $10, start. The habit matters more than the amount. Second, educate yourself. Read trustworthy books like The Millionaire Next Door or Your Money or Your Life. Learn about the basics, budgeting, emergency funds, and the difference between active and passive income. Platforms like Investing.com even offer demo challenges where you can test your strategies with virtual money. No risk, just learning. Third, automate your investments if you can. Set up automatic transfers so you're investing regularly, rain or shine. This takes the emotion out of the process and helps you stick to your plan. And finally, play the long game. The difference between $10, $1,000, and $10,000 isn't just the number, it's the mindset. Anyone can start, but only those who stick with it, keep learning, and avoid the urge to get rich quick will see their investments truly grow. So, whether you're starting with pocket change or a small windfall, remember, what matters most is not where you begin, but how you play the game. The next decade is going to pass whether you invest or not. The question is, when you look back, will you wish you'd started today? The doors are open. Which one will you walk through?